Hello, this is Susan Hayes, the Positive Economist, and today I'm going to talk to you about exchange traded funds in a series of videos called InvestingInYouth.com, Introducing Wall Street to the Classroom. Now, exchange traded funds are the fastest growing financial product in the world, and here's why. You already know of two strategies to pick direct stocks. I referred to those already in earlier videos on my channel that you can subscribe to. However, for diversification you would need enough money in a strategy of buying direct stocks to buy about 10 companies to start off. But what if you just started a new job or had some money that people gave you for your 21st? You don't have enough money to buy a strategy, but you do want to invest. Or what if a mother is seeking a place to invest the child benefits she receives so as to let her money grow and then pay for her child to go to college in the years to come? Again, while she does receive a regular income, she doesn't have enough to buy a strategy. Or what about a man who asks you where to invest his pension? He has a significant amount of money but doesn't want to have to manage a strategy, or simply doesn't want to have to pick direct stocks. Or what about the lady who knows little about the Chinese market? However, the company she works with is sourcing more and more supplies in China. She is reading a lot about the development of the country and feels growth prospects are high. So she wants to invest in the market, but doesn't know enough about individual companies to invest in them. And an investor has invested most of his portfolio already, but has learned that the Irish market has fallen quite significantly in the downturn, and he feels that it is quite undervalued. He hasn't enough money to buy a number of companies, but does have enough to buy one or two. So what should all these people do? Have they no choice but to stay out of the stock market, or to take chances on one or two stocks and simply hope for the best? Well, of course not. Introducing exchange traded funds, as I mentioned, the fastest growing financial product in the world. What characteristics does a selection box that you buy at Christmas have? Well, you have a choice of different bars of chocolate. You only have to pay one transaction instead of buying several bars of chocolate. You pay for the packaging, the box around them, and they can be bought off the shelf in a shop. Well, how does that relate to an ETF? Well, very similarly in fact, because an exchange traded fund is a basket of stocks that provides diversification in one transaction with a small charge for the wrapper, which can be purchased on the stock market. As a basket of stocks is similar to a selection box of chocolate, and bear in mind, if you buy a selection box you have a choice of chocolates to eat. Well, similarly, if you buy an ETF, there is a choice of companies within it. This all happens in one transaction, so you would buy several bars of chocolate in one transaction by buying a selection box, and similarly you would buy several different companies all in one transaction by buying an ETF. There is a small charge for the wrapper around the fund, and also you can buy this fund directly on the stock market. You don't have to go through a life insurance company to do so. And do you know how selection box producers choose which bars are to be included in a selection box? No, I don't either. But what I do know is how ETFs choose what stocks to put in their baskets. Remember indices. Remember we spoke about the S&P 500, the FTSE 100 and the ISEC. Well, an ETF simply tracks these indices. Now what I mean by track is that, let's say a fund manager would open the paper on the 1st of January 2010, and she sees that there's 100 companies obviously that are in the index of the FTSE 100. Well, all she has to do is simply go and buy all of those funds in proportion to their weighting in the index to make up the ETF. So the ETF provider, like Nestle in the ETF world, buys the stocks that are in the index, and this makes up the fund. So now that's where it stops from their perspective. And from your perspective as the buyer, you have bought the S&P 500 or the FTSE 100 or whatever other ETF that is available. So why would you do that? Well, again, you would buy several stocks in one transaction. You don't need that much money. If we're to look at any one of the cases that we dealt with earlier, we were trying to stretch a small amount of money across a large number of stocks. Apart from the pension, remember, he had a lot of money but he just didn't want to manage it. But of the four others, there was small money. Now, as I said, it's not a good idea at all to simply buy one or two stocks and hope for the best. So what each of those people could do was simply take an ETF and buy it, because they've got automatic diversification. And since you only have to pay one transaction cost for this exposure, you can pay a relatively small amount in transaction costs. Now you do have to pay a small charge for putting the fund together, but bear in mind you are paying this small charge, but what you don't have to pay is a large number of transaction costs to buy all of these companies individually. And as I mentioned, you can buy this easily through the stock market. So how does it solve the problems of the previous cases? Well, I dealt with this in a general sense in the last slide, but now let's take each person individually. The person with the new job, or the person who has money from their 21st? Well, by buying something like the ETF that I mentioned earlier, of the S&P 500 or the FTSE 100, you can gain a lot of diversification with just one transaction. So with a couple of €100, you're exposed to maybe 100 or 500 stocks, and you only have to pay one transaction cost. So that is a way you can intelligently invest. And the lady with the child benefit, well, in her case, she can wait and gather up all the relatively small amounts in child benefit that she gets until she gets a couple of €100 together and buys an ETF with it. In this case, like the last person, she's got automatic diversification and she has to pay relatively little with it. And as this would build up over the 18 years of her child's youth, well then she would have quite an amount at the very end to put her child through college. Now, the man with the significant amount in a pension, in this case you want to spread the money fairly widely. So you'd want to maybe diversify in terms of geography first of all. So you might want to buy an ETF. The world ETF would be an example, or maybe an Asian ETF, a European ETF, an American ETF. He might want to diversify across asset classes. So he might want to buy into a hedge fund, private equity ETF, etc. Maybe across bonds, equities and commodities. So, but as you can see, this would be a very, very difficult thing to do if you were to take every single asset class, every single company in every single part of the world. But there's about 1,600 ETFs, and he could basically whittle it down to what his basic needs are and find an ETF that does that. The lady in the Chinese market, well, what you can do there is very simple. Take something like the Xinhua 25, which would be the equivalent to the FTSE 100 in London or the S&P 500 in America. It's simply the index in China. So she doesn't have to go off and research Chinese companies and try to read Chinese reports or anything like it. She simply buys the index and tracks it. And similarly, the person in the Irish market. Well, it's not the case here that he doesn't have the knowledge. What he doesn't have is an awful lot of money left over because a lot of his portfolio is already invested. So what this person can do is simply buy the ISEC ETF. Buy the ETF that simply tracks the Irish market to gain exposure to the market, again with very little cost. Now there are thousands of ETFs as I mentioned, so which do you choose? Well, first of all you need to identify what you actually want to track. There is no point buying the S&P 500 if you want exposure to the UK market, for example. And also what sort of diversification is involved. Well, let me give you a very simple example. The Dow ETF in America tracks 30 stocks. The S&P 500 ETF in America tracks 500 stocks. So you have to decide, well, what type of diversification do I actually want? What is the expense ratio? Now this is the amount, as I mentioned before, the expense of the wrapper. Now in the case of an ETF, it can be anything from 0.1% to 1%, so the costs are quite low. And what is the dividend yield? Well, of course you would always like to make the most of this, in that you would like to make the most of an income from your money from an ETF, if you were in the case of looking for an income. If you're simply looking for capital return, well then this is irrelevant. And the last thing I would mention in this video is iShares.com. I, in this case, stands for index shares. This is one of the best websites out there for researching ETFs, and it really whittles it down again to asset classes, geography, etc. So if you were going to start looking at ETFs, this is the first place that I would spend some time looking at. Of course, if you have any questions, please do post a comment in my comment box, or also you can always go to my website investinginyouth.com to send any questions that you may have. This is Susan Hayes, the Positive Economist.